The Panic of 1873. The Panic of 1873 marked the beginning of what would later be called the Long Depression, a global economic downturn that lasted from 1873 to 1879 in most places, and even longer in some. It started in Vienna when the stock exchange crashed following rampant speculation in railway building and the collapse of several major banks. At the heart of the crisis was the overexpansion of credit and speculative investment, particularly in railroads in the US and infrastructure across Europe. American financier J. Cook and Company, heavily invested in railroad bonds, went bankrupt in September 1873, triggering panic in US financial markets. Stock exchanges closed temporarily, banks failed, and thousands of businesses went under. The impact was massive. Unemployment spiked, wages fell, and the working class suffered deeply. In Germany and Austria-Hungary, industrial production slowed and social unrest increased. In the US, the Depression reshaped labor movements and fueled debates over monetary policy, particularly the gold standard versus greenbacks. The 1929 crash. The 1929 crash is arguably the most iconic financial disaster in history. Known as Black Tuesday, October 29th saw the Dow Jones Industrial Average plummet by nearly 12%. This crash didn't come out of nowhere. It followed a speculative stock market bubble throughout the 1920s known as the Roaring Twenties. When the bubble bursted, millions of Americans had already invested in the stock market, often with borrowed money, margin buying. When prices started to fall in late October, panic selling ensued. Within a month, the market lost nearly half its value, and it kept declining for years. This crash was a key trigger of the Great Depression. Banks failed in the thousands. Industrial production fell by nearly 50%, and unemployment in the US rose to 25%. Globally, trade collapsed, and political extremism gained momentum, setting the stage for upheaval across Europe. The crash of 1973. The crash of 1973 was not triggered by financial speculation, but by geopolitics. In October 1973, during the Yom Kippur War, Arab members of OPEC imposed an oil embargo on nations supporting Israel, including the US and Western Europe. Overnight, oil prices quadrupled. This sudden spike in energy costs shocked economies worldwide. It led to what economists called stagflation, a combination of stagnating growth and high inflation. Stock markets fell sharply, and industries reliant on oil, transportation, manufacturing suffered major losses. Western governments implemented rationing, while central banks struggled to find the right monetary response. This crash fundamentally altered the relationship between energy markets and global finance. It also led the US to strengthen their influence and involvement in the Middle East. Black Monday, 1987. On October 19, 1987, global stock markets experienced their worst one-day percentage drop. The Dow Jones Industrial Average fell 22.6%, the biggest single-day decline in history. Several factors contributed: overvalued stocks, growing trade deficits, and computerized program trading that automatically sold stocks during declines. As prices fell, the machines accelerated the sell-off. Interestingly, while the crash was severe, it did not trigger a broader economic recession. The Federal Reserve quickly stepped in, reassuring markets and providing liquidity. Still, Black Monday revealed how fragile financial systems had become in the era of digital trading. The Japanese asset bubble. Japan in the 1980s was considered an unstoppable economic force. Real estate prices in Tokyo skyrocketed, and the Nikkei stock index tripled in just a few years. This was fueled by easy credit, speculative investment, and lax financial oversight. By 1991, the bubble burst. Land values fell sharply, and the Nikkei lost over 60% of its value by 1992. Banks were heavily exposed and stopped lending. Japan entered what became known as the Lost Decade, a period of stagnation that, by some measures, lasted until the 2010s. The effects were long-lasting: deflation, a demographic crisis, and declining global competitiveness. The dot-com bubble of 2000. Fueled by internet hype, tech companies in the late 1990s soared in value, many despite having no revenue or profits. When investor enthusiasm dried up in 2000, the bubble burst. The Nasdaq lost nearly 80% of its value between March 2000 and October 2002. High-profile companies like Pets.com disappeared overnight. While the broader U.S. economy eventually recovered, this crash served as a major wake-up call about speculative mania and the importance of sound fundamentals. The financial crash of 2008, caused by subprime mortgage lending and risky financial products like collateralized debt obligations, CDOs, the 2008 crisis began in the U.S. housing market. As defaults rose, mortgage-backed securities collapsed in value. Lehman Brothers went bankrupt, and panic spread worldwide. Banks stopped lending, credit markets froze, and global trade slowed. Governments injected trillions to prevent total collapse. The recession that followed was the worst since the Great Depression. Its effects are still felt today. Rising inequality, increased regulations, and distrust of Wall Street. The 2025 market crash is still unfolding. Triggered by persistently high inflation, aggressive interest rate hikes by central banks, and slowing global growth, markets entered bear territory in early 2025. Tech stocks, especially AI and green tech firms, led the downturn. In Europe, rising sovereign debt and political instability have intensified fears. In the U.S., commercial real estate defaults and falling consumer confidence have deepened concerns. A key contributing factor has been the reintroduction and expansion of tariffs by the Trump administration, targeting key imports from China and the European Union. These measures were initially aimed at protecting domestic industry, but have instead led to retaliatory tariffs, supply chain disruptions, and increased production costs for U.S. manufacturers. So far, the tariffs have resulted in volatile market movements and have not delivered noticeable economic benefits for the U.S. economy. Supporters argue that the administration is playing a long-term strategic game to rebalance trade relationships and bring back manufacturing. Critics, however, point to what they see as impulsive leadership and a limited understanding of global trade dynamics, factors they believe have significantly contributed to a broader economic downturn. Which perspective history will ultimately validate remains to be seen.